It seems crazy, right? Millions of rides happen every single day, all over the world. The app is on everyone's phone. Surely they must be rolling in cash. Stick around, because this story might just change how you see the entire gig economy. So, let's start with the basics. When you open the Uber app and book a ride, you see a fare. Let's say it's $20 for your trip. You might think, great, Uber just made $20. But that's where the common misconception begins. A huge chunk of that fare goes directly to the driver. This is of course essential. Without drivers, there's no service. But Uber's relationship with its drivers is more complicated than just a simple payout. These are called subsidies. So, of that $20 fare, Uber might pay the driver, say, $16. Already, we're down to just $4. But the spending doesn't stop there. How did you hear about Uber in the first place? The answer is marketing, and lots of it. We're talking about discount codes, referral bonuses, and massive advertising campaigns. We're now left with just $2. And we haven't even touched the core operational costs yet. Every tech company has enormous overhead. Uber has to pay for a global network of servers to keep the app running smoothly 24/7. They employ thousands of software engineers, data scientists, product managers, and support staff. Think about the research and development that goes into improving the mapping algorithm, optimizing rider-driver matching, and ensuring safety features work flawlessly. They also have physical offices in cities all over the world, legal teams to navigate complex local regulations, and insurance costs that are astronomical. All of these expenses, salaries, rent, technology, legal fees, have to be paid from that tiny sliver of revenue left over from each ride. When you factor all of that in, that $2 margin can very quickly disappear and turn into a loss. On a single $20 ride, Uber might actually lose money. Now, multiply that effect across millions of rides a day, and you start to see the scale of the financial challenge. But wait, there's more. Uber isn't just a rideshare company anymore. A huge part of their strategy is diversification. You've heard of Uber Eats, right? This move into food delivery was a massive undertaking. It required building a completely new logistics platform, signing up millions of restaurants, and marketing the service to a whole new customer base. While Uber Eats became a lifeline for many during the pandemic and has grown into a colossal business in its own right, it came with its own set of immense costs. The competition in food delivery is fierce, with companies like DoorDash and Grubhub all fighting for the same restaurants and customers. This means more marketing spend, more driver incentives, and razor-thin margins. For a long time, Uber Eats was another significant source of losses for the parent company, and the ambition doesn't stop at food. Uber has ventured into freight, scooter, and bike rentals, and even, for a while, the futuristic dream of self-driving cars. The self-driving car project, in particular, was an enormous cash burn. The idea was that if they could replace human drivers with autonomous vehicles, their biggest single cost, paying drivers, would vanish, leading to massive profitability. It was the ultimate long-term play. However, developing autonomous technology is one of the most difficult and expensive engineering challenges in the world. After spending billions of dollars, Uber eventually sold off its self-driving division, recognizing that the path to a driverless future was much longer and more costly than anyone had anticipated. Each of these ventures, while strategically sound in theory, added another layer of expense to the company's bottom line, pushing the goal of overall profitability further down the road. This brings us to the core of Uber's strategy, a philosophy that defines much of Silicon Valley: growth at all costs. The game plan from the very beginning was not to be profitable in year 1 or year 5 or even year 10. The goal was to achieve market dominance. The strategy is to enter a market, slash prices, and spend heavily to acquire as many customers and drivers as possible, as quickly as possible. The aim is to become the default choice, the undisputed leader. The underlying belief is that once you've achieved that scale, once you have a massive loyal user base and have pushed out most of the competition, you can then slowly start to tweak the model. You can gradually reduce rider discounts, decrease driver incentives, and increase prices. At that point, with the competition weakened, customers and drivers will have fewer alternatives, and the company can finally begin to reap the rewards and turn a consistent profit. This is a high-wire act. It requires access to vast amounts of investor capital. For years, venture capitalists and public market investors were willing to pour billions of dollars into Uber, betting on this long-term vision. They weren't looking for quarterly profits. They were looking for explosive growth in users, rides, and market share. They were funding a war for territory, not a conventional business. The risk, of course, is that profitability might never fully materialize. What if customers are only loyal because of the low prices? What if drivers only stick around because of the incentives? If Uber raises its prices too much, will customers simply go back to public transport or a competitor? If they cut driver pay, will drivers leave the platform, leading to longer wait times and a worse service? This is the delicate balance Uber has been trying to manage for over a decade. So, what's the verdict today? Has the strategy paid off? In recent quarters, Uber has managed to post its first ever operating profits. This is a monumental milestone. It suggests that after years of relentless spending, the company might finally be turning a corner. They've become more disciplined with their spending, shed some of their more speculative and costly ventures like the self-driving unit, and benefited from the massive scale they've built, especially with the growth of their high-margin advertising business within the Uber Eats app. However, the path to sustained, predictable profitability is still a work in progress. The market is dynamic and competition remains. The question of how to fairly compensate gig workers is a legal and ethical battle that continues to rage globally, and any new regulations could significantly impact their cost structure. What can we learn from Uber's journey? For any aspiring entrepreneur or business enthusiast, the story of Uber is a masterclass in the trade-offs between growth and profitability. It shows that, in the digital age, sometimes the path to success involves a long period of intentional, strategic losses. The goal is to build a moat, a sustainable competitive advantage, in this case, a powerful network effect, that will pay dividends in the future. However, it's also a cautionary tale. This strategy is incredibly risky and requires an almost endless supply of cash. It's not a model that most small businesses can or should try to replicate. It highlights the critical importance of understanding your unit economics, knowing exactly how much you make or lose on every single transaction. Without that clarity, scaling up can mean you're just scaling up your losses. Ultimately, Uber changed the world. It redefined transportation, created the modern gig economy, and set a new standard for on-demand services. But its financial story proves that changing the world and making money are two very different things. The company is a testament to the power of a big vision and the willingness to bet everything on long-term dominance. Whether that bet will ultimately result in a stable, profitable powerhouse for the decades to come is a chapter that's still being written, and we'll all be watching to see how it unfolds. Thanks so much for watching. If you found this breakdown interesting, please hit that like button and subscribe for more deep dives into the businesses and technologies that shape our world. Let me know in the comments what you think about Uber's strategy. Is it brilliant or reckless? I'd love to hear your thoughts. See you in the next one.